It's a Sunday evening, and I just really wanted to interact with you regarding one of the regulatory changes that is going to take place in the Indian equity market. So, as you all know that last couple of years have been arguably very much, you can say that, robust in terms of regulatory changes that have been taken place recently, be it the margin settlement process, be it your peak margin requirements, FNO settlements, physical settlements of stock options, plus the MTF pledging system that came during September 2021. It was a pandemic year, and a lot of brokers have struggled to adjust themselves into this new system. So recently, I mean, this month only, or you can say that this week only, regulators have come up with one more change into the Indian equity market, which is known as change of settlement cycle. So I would just like to discuss it with you guys. Before starting the dialogue, I would like to give the same basic disclaimer that the views expressed here are my personal views, and it has nothing to do with my current employer. So as you must be knowing that recently, last week only, Security and Exchange Board of India have come up with a circular where they have decided that all the settlements that will be done in the Indian equity market will be moving from T+2 settlement to T+1 settlement cycle. So let's understand that what actually T+1 settlement is, and we have to understand the basics of settlement cycle. So what is settlement cycle? And before starting it, I would like to give the due credit that I have taken some of the inputs from the National Stock Exchange website. So due credit to the researcher or the author. I have taken some inputs from there. So whenever you buy or sell stocks, you have to wait for T+2 days for the stocks or sell proceeds to reflect in your demat account. So this is known as actually the settlement cycle. Till recently, my dear friends, Indian regulators followed T+2 settlement cycle, and cheers to all of us, all of us, that now SEBI has put out a circular providing flexibility to stock exchanges to offer T+1 settlement of stocks. So let's first of all understand that what actually is the history of trade settlement into India. So initially, all the trading settlements on Bombay Stock Exchange, that is BSE, used to happen between Monday and Thursday. So initially, this was the settlement cycle, and final settlement used to occur on the Fridays. So this whole settlement process was through the physical movement of paper. So there was no electronic mode, and there was no electronic settlements follow-ups. So it all used to happen on the paper. So when NSE, National Stock Exchange, came into existence, it also started the settlement cycle on fixed days only, that is Wednesday, as settlement days. Later they shifted this to Tuesdays. From Wednesday they shifted it to Tuesdays. So this weekly settlement system actually infused liquidity in the market, because traders and other could buy and sell without having to pay immediately, which ultimately led to speculative activities in the cash market. The widely infamous Harshad Mehta scam, as you all must remember, that this happened due to this particular loophole actually. So to reduce the risk associated with the so-called fixed day settlement system, the Security and Exchange Board of India introduced rolling settlement in July 2001. So from fixed Wednesday and Tuesdays kind of settlements, they moved to the rolling settlement cycle in 2001. The settlement process for a trade contract begins at the end of the trading day, now famously termed as T-day. T-day means trading day. So initially it was introduced for a limited scrips on a T+5 basis, and then expanded to other scripts in a very planned manner actually. All scripts moved to rolling settlement from December 2001 onwards. T plus 5 was replaced with T plus 3. They have cut short the settlement cycle from T plus 5 to T plus 3 in April 2002, and later it was replaced by T plus 2 in April 2003. So since April 2003 we are following a settlement cycle of T plus 2 actually. So it's been almost 19 years since we are following this particular settlement cycle. What is current scenario? India is the second largest market after China to implement the T plus 1 settlement cycle in stocks. Most international markets like United States, Europe, etc. are still in the T plus 2 settlement cycle. Well, this means when you buy a stock or a bond, it will start reflecting into your demat account after a period of 2 days, and when you sell it again, it will take 2 days to reflect in your bank account or your system. So actually, after China, India is the second largest economy or the second largest market who has decided to implement this T plus 1 settlement cycle. US and Europe are still continuing with the T plus 2 settlement cycle. So one question might be infused in your minds, that why T plus 2 or T plus 3 or T plus 5 or T plus 1 settlement cycle? Why not T plus 0 or instant settlement? So this question of why we can't have an instant settlement in today's world where UPI is powering almost 4 billion bank transfers a month, all settled instantly, keeps coming up. These news keep coming us that India is the largest growing economy wherein we are using UPI that settles bank accounts immediately. So this equity market settlement is very different from typical banking transactions. You have to first understand it. Where money is immediately in normal UPI transfers or bank transfer, the money is immediately transferred from one account to another. Here the cash and the stock both are involved, and usually stocks can't be settled due to intraday trading. So if you observe, the majority of trading volumes on the stock markets across the world seems from intraday traders who are constantly buying and selling stocks without actually taking or giving the money. Typically these intraday trades exist their positions before the end of the day, and the obligation to deliver the stock will eventually land with someone who holds the stock. So there are hindrances from the clearing corporations, and there are multiple parties involved into settling the stocks. We can reduce the settlement cycle up to T plus 1 day, and we simply can't do this on the instant basis or a T plus 0 basis. So this is actually the summary of the recently introduced regulatory guideline, which reduces the T plus 2 settlement cycle to T plus 1 settlement cycle. So this will actually create more liquidity into the Indian equity market, and hopefully someday or the other we will come to a process wherein the immediate liquidity and immediate transfer of shares is available in the Indian equity market. So this will definitely help a lot of retail investors. This will definitely going to attract more retail investors due to this instant liquidity into the Indian equity market. Hopefully this will suffice to understand the basic changes that have taken place. Thanks for tuning in. Thanks for watching. Stay happy, stay healthy. Thank you. Thanks a lot.